rules. Money rules. Money. Welcome to the Money Rules podcast, where we tackle your personal financial matters with leading financial advisors. Your host, Withdrawals.
Today, we're exploring an essential aspect of retirement planning in South Africa, Section 10C of the Income Tax Act. We'll uncover how investors can leverage this provision to optimize their retirement savings and potentially enjoy tax-free income during their golden years. Joining us today to share insights on this is Elke Brink, who is a wealth advisor at PSG Wealth. Welcome, Elke. It's a pleasure to have you on the show.
Thank you so much, Moneyweb. Good to be here.
Before we start, please don't forget to follow us on Spotify and Apple Podcasts, share this podcast with your friends, and download our episodes for easy listening on the go. Elke, can you explain what Section 10C of the Income Tax Act is and its significance in retirement planning?
Yes, so Section 10C is a very underutilized benefit when it comes to your retirement planning. And this is specifically for post-retirement, so after the age of 55, that you have a really cool benefit that you can utilize that a lot of investors are not aware of. So basically what it comes down to is that pre-retirement, you have a tax benefit or a deduction you can utilize when it specifically comes to your retirement funds. So what the rule says is you are allowed to save up to 27.5% of your taxable income within a retirement annuity or your pension or provident fund at work or a combination. And you can claim these contributions, the 27.5%, back from SARS on an annual basis up to a maximum of 350,000 rands a year. So you have this deduction. But if you were to contribute anything over and above either your 27.5% or your 350,000 rands a year, this is referred to as a disallowed contribution. And it essentially starts pooling up in a separate pool, if I can refer to it like that. And you can optimize this benefit once you get to retirement, which I'll explain now. So in principle, you can't use it now before retirement. You can't use it as a deduction. But this pool that we build up, we can at retirement offset against your income tax that you will be paying at that stage. So the moment you retire, we reconvert your retirement portfolio either to a living or a life annuity where you now start drawing an income. And this income is taxed on the income tax scale, normally like your salary is taxed at the moment. So you just taxed on a normal scale. And this income tax is allowed to be offset by this disallowed pool. So the larger the pool you can build up, you can essentially not pay tax for a few years within retirement.
Elke, could you walk us through how investors can make the most of this provision and improve their retirement savings?
Yes, so there's a few benefits, not only for the income tax saving you can create in future, but in the interim, so before retirement, but also after retirement or during retirement. Anything that's in your retirement product, so let's say pre-retirement or post-retirement in your living or life annuity, is excluded from your estate. So it's actually a really cool benefit to optimize these benefits to ensure you're taking care of your loved ones. There is something to take into account with the disallowed contributions, which I will elaborate on a bit later. But in principle, I would recommend for any investor to focus as soon as you can in your lifetime to save more than your annual deduction, so more than your 27.5% or 350,000 maximum within your retirement portfolios as you start building up this pool over a lifetime. It's not necessarily something you have to do before retirement. So, for example, what we do with investors that have already reached 55 or older, you can, in one moment, for example, transfer a lump sum to a retirement annuity, and the next day or the next few weeks, transfer it to your living annuity. So you can optimize Section 10C within a few weeks if you have a large lump sum available to exceed that 350,000 rands a year. But for the average person, it's easier earlier on in life out of a cash flow perspective to do it earlier on. So to basically do your 27.5 and more the moment it is affordable for you.
Elke, During the pre-retirement stage, if an investor has a retirement annuity and a pension fund at work, which of these should they optimize?
I always recommend when you have a personal retirement annuity and a benefit at work is to do a bit of an analysis on it in terms of how it's invested. It very much depends what strategy your employer is following with the investment strategy. But a wealth advisor can do a proper analysis for you in terms of the diversification, the return, perhaps the underlying fund managers you have. And then I would recommend choosing the optimal portfolio between your individual capacity or the group capacity. In most cases, sometimes as an individual, you have more options in terms of underlying fund managers on an individual basis compared to a group scheme. But that's not always the rule. But I would recommend an analysis and choose the best performing and best diversified route to go.
Now, when you're at the retirement stage, how do these disallowed contributions come in handy?
So when we reach retirement, this is actually quite convenient because SARS keeps record of the disallowed contributions. So they automatically know about it when you reach that stage. So it has to be over the age of 55. And then what is quite important is when it comes to the income tax that we now want to set off this pool again, it can only be offset against an income earned from a living annuity or a life annuity, not other sources of income, for example, rental income or something. It has to be the living annuity or the life annuity. The moment you then retire and you have this post-retirement product, so the living or life annuity, and it automatically happens with SARS, but I normally recommend just to be sure to use your accountant or tax practitioner together with your wealth advisor and to ensure that SARS is aware of your disallowed contributions. And then automatically we can now offset your tax, and you are essentially, depending again how big your pool is, you don't have to pay income tax until this pool is depleted. So let's use as a random figure, let's say you have R1 million built up in your pool and you are earning an income that triggers roughly 100,000 rands of tax on an annual basis. You can for 10 years not pay income tax. So this is actually a wonderful benefit in terms of course, obviously ensuring you have sufficient retirement provision, but also creating a very tax efficient retirement, because a lot of investors tend to forget that at retirement you still have this income tax duty. So it can potentially be a large part of your income that you are sacrificing to income tax.
Okay, I just want to take a bit of a step back. So if you have these disallowed contributions, are you allowed to withdraw a bit more when you retire just above the 550,000 Rand limit?
Yes, so there are two ways to optimize this allowed pool. Either you can do a lump sum withdrawal, so that would be a once-off benefit you get. So in principle, when we reach retirement, at the moment legislation states you have 550,000 rands tax-free. This is always quite important just to do an analysis at that stage, because if there is any funds owed to SARS, or if you have ever been retrenched, this can impact the 550,000. But in principle, we have 550. Let's say your disallowed contribution was another 500,000. You essentially have another 500 you can add to your 550 that will be tax-free. And then you withdraw this as a lump sum. So this is a bit of an either or. Either you can take a larger tax-free lump sum at retirement, or you can decide to offset that lump sum against your income tax on a, let's say, monthly/annual basis until the disallowed pool is depleted.
And could you elaborate for us on how investors can utilize disallowed contributions to minimize taxes on their retirement income?
Yes, so this only happens once you have now converted. Let's say you have a combination of a retirement annuity and a pension or a provident at work. The moment you retire, we consolidate these investments and we open up, for example, a living annuity for you after retirement. This living annuity income needs to now be between 2.5% and 17.5% of fund value. Depending on what income percentage you choose will depend what tax is payable on the income tax scale for you as an individual. And that income can now be offset against your disallowed contributions. So very important, this benefit is only actually for when you reach retirement. You can't utilize it before retirement.
And will life annuity investors have this benefit as well?
Yes, again, you can also offset it against your income tax. So it's specifically for living or life annuities until the pool is depleted. So the larger you can build the pool, the longer you don't have to pay income tax at that stage in life. What is important, what I wanted to mention earlier in terms of estate planning. So in principle, a retirement annuity or a pension or a provident fund or any retirement product or a living or a life annuity post-retirement is not included in your estate. So these benefits go to your beneficiaries nominated immediately. But the disallowed pool is seen as an asset in your estate. So that's just quite important. If you have not depleted your pool yet, that little excess part will form part an asset in your estate when it comes to estate duty purposes.
And Alka, can other investments complement Section 10C to help investors create a tax-free retirement income?
What I normally recommend, and when we're planning the perfect retirement, if I can explain it like that, is that to try to see not only that we're creating a tax-efficient portfolio, but also to create some liquidity in your portfolio for emergencies or holidays or any unforeseen expense. So normally what I would recommend, so something to keep in mind if we're benefiting from 10C, it's all kind of restrictive products in terms of a retirement annuity or a pension or a provident fund, especially with the two-pot system coming in, or post-retirement, the living or life annuity. All of these products can't be accessed as a lump sum. So I normally recommend optimizing a tax-free investment, which again brings a big tax benefit to your portfolio. So this is the investment that you are allowed to do 36,000 rands per year and 500,000 rands in your lifetime, contribution-wise, but it can technically grow to wherever. So if you can optimize this investment, which is an accessible investment, you can potentially build up another few millions, depending on your timeline, but it's 100% accessible and it's tax-free. So you can build this up as an additional source of income with your living or life annuity. And knowing that you have readily available funds for whatever additional expenses you have. And then normally I would also recommend optimizing a normal, voluntary, or flexible investment. And again, the reason for this would just be to have some liquidity in your portfolio at retirement. And as an individual, you have certain annual exemptions. So, for example, on interest earned, on capital gain tax payable, this normally refers to equities. So, if you as an individual optimize all of your possible tax benefits annually, then you can have a few different products, but have the most tax efficient environment because you're optimizing all the different benefits you have.
Elke, before we wrap up, do you have any final tips or advice for our listeners regarding retirement planning and tax optimization?
Yeah, I think maybe to wrap up, I would recommend that investors rather start earlier on in life to ensure that they are making the most of all their tax optimization. So you can have a perfect portfolio earning double-digit returns, but if you're not planning sufficiently out of a taxation point of view, tax hurts you a lot in the end. And the higher net worth individual you are, the more tax is going to hurt you. So tax is equally as important as the portfolios and the returns you are getting. So making sure that you are planning out of a taxation point of view and not being scared of a retirement fund. I think there's sometimes a misaligned reality in South Africa that people are scared of the restrictiveness or scared of a retirement fund, where there are exceptional benefits within these products if you really understand the estate planning benefits and the tax benefits. And of course, if it's managed properly, you can earn very good returns. So one of the main benefits pre-retirement that changed in the last year was that you are now allowed to invest up to 45% offshore, which it was always 30%. So there's a very good diversification benefit also. So really, there are so many pros to using this product optimally in your portfolio. And I think for the average person, out of a cash flow point of view and a planning point of view, it's just easier doing it on a monthly basis. And the more